Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes. This is VideoCast, episode 65, podcast episode 55 for the week ending January 15th, 2021. A lot to cover today. We're going to start off with our media spots so we can cover a lot of information in a short period of time. And we have a lot of new stuff to cover on this call, so I'm going to speak faster than normal to squeeze it all in. First, I'd like to thank Liz Klayman and Ed Krajewski for having me on the Klayman Countdown this afternoon. And we discussed retail sales were a little weak, negative 70 basis points versus negative 20 basis points estimated. But the last print was negative 1.4%. And this was attributable, I laid out with Liz, to the delayed stimulus, the political wrangling that happened before and after the election hurt confidence a little bit. The regional shutdowns and the case spikes hurt confidence. So that hurt retail sales for the most recent print. It also hurt Michigan consumer sentiment, missed expectations, 79.2 versus 80 versus 80 on the estimates and 80.7 on the last print. So you saw retail and travel and leisure down today, Michael's stores, Bed Bath & Beyond, GameStop, the airlines, the casinos, etc. And then we talked about bank earnings. So basically what you had today was all three banks beat earnings estimates on the bottom line. Only JP Morgan beat on the top line. Citi and Wells Fargo missed on the top line. So Citi and Wells Fargo were off 6 and 7%, and JP Morgan was down about 1 or 1.5%. And what I said to Liz was, in the last 10 weeks, Citibank is up 72.5% in 10 weeks. Wells Fargo was up 70% in 10 weeks going into earnings. So the fact that they corrected 6 and 7%, it was basically a buy the rumor, sell the news. And then JP Morgan was up only 50% in the last 10 weeks, and they only corrected 1.5%. So this certainly was buy the rumor, sell the news. And what I laid out was, in coming days and weeks, as you see weakness, this will be an opportunity to pick them up for the long term. On Wells, maybe you'll get it in the low 30s. If you're lucky, you'll get it in the high 20s, and just tuck it away and don't worry about the volatility. That's a big holding for us. We have from the low and mid 20s, quite a nice position, and it's had quite a nice run in the last 10 weeks. So that's just an opportunity. Looking forward to next week, we're looking at Bank of America and Goldman Sachs. Now expectations are lower. They will probably positively beat on Tuesday. The market's closed on Monday. And then Morgan Stanley's the day after that. And then you got big tech on Thursday with IBM and Intel, Dow components. So we get to see a sense of corporate demand for enterprise and for chips. And that was basically that. So thank you to Liz and Ed for having me on today. Then moving along to last night, Chibuke Ogu asked me for some thoughts on the markets after the close. The market was down after the stimulus. We'll talk a little bit about that, the stimulus announcement, rather. The market wasn't happy. And that really has to do with expectations. President-elect Biden is probably not very accustomed to speaking to the market, and maybe he doesn't really care what the market does, but he had promised trillions, multiple trillions last week in the new stimulus. This first batch is 1.9 trillion. Didn't get up to 2 or 3, which was the implication of the earlier words. So met or not quite met expectations. Market was a little soft on that. We'll speak to that because there's the second package, the clean energy and the infrastructure that'll come after the fact. But I said really the market wants to see what the banks are going to say tomorrow. If they're starting to take down credit reserves, resume buybacks, and provide guidance that shows the economy is improving. all three of those things happened today. I think it was profit taking. I think you'll probably see a little more. Generally, when you see it sell off like that, you wait, 3 days, and then you start to nibble and pick up for the long term. Remember, in the case of Citi and Wells, they're still trading at a discount to book. That's a long-term opportunity. And, we'll talk about some of the catalysts moving forward. But all in all, generally positive and good day on that front. Next, on Wednesday night, I was on BBC World News with Mariko Oy and want to thank Mariko and Derek Kai for having me on. And what she wanted to know about was the impeachment in the House and the impact on the markets. And basically I said it's more symbolic than substantive. Certainly it's the first president to be impeached in 2 times of 45. 10 Republicans joined, so 222 Democrats. So it was a clear message about their feelings about what happened last week. And but he'd have to be impeached by the Senate, which at that point we knew was not going to happen before the inauguration. And then there comes a constitutional question. Can you remove someone who from office who's no longer in office, which will be the question in the Senate? So even if they have the trial to try to impeach him, it's unclear whether, even if they're successful and it requires a 2/3 vote, which they may or may not get after the trial, would it preclude him from running 4 years down the road? And constitutionally, I think probably not, but I'm not a constitutional lawyer, and that is because as defined by the Constitution, it's designed, the act of impeachment is to remove someone from office. Someone no longer in office can't be impeached, which is why they would need to have the trial on the 19th, and the senators won't be back. So that's that. The other reason the market was down, as far as Chibuke's article, was that on the impeachment news, the market was worried that now the Senate and Congress will be more focused on the past than the future, meaning they'll spend all their time trying President Trump for impeachment in the Senate to remove him from an office he's no longer in, instead of getting through the stimulus packages and getting through the infrastructure packages and moving the country forward. And it may very well muck up with an M or an F if you're a close friend, but it may well muck up the first 100-day plan that every president likes to come out of the gate strong, get all their initiatives done. And if you blow that, you generally get the goodwill for the 100 days. And if you blow that because Congress is distracted on other things, it hurts the country and hurts a lot of people who need help right now. So hopefully they don't make that mistake. But so far it looks like they're headed in that direction. And I think that's partially why the market was a little soft today. In addition to the banks and everything else, it was the stimulus didn't meet expectations. Is Congress going to be distracted? Banks was a sell the news and profit taking, and then they'll take a breather for a few days or weeks, regroup, and then they'll go on to make new highs. And then the other point was she asked about the New York City contracts. It's immaterial. I mean, basically, that's $17 million a year to the Trump organization. It is what it is. The carousel, the skating rinks, and the golf course. It'll be interesting to see, though, because when they took over the Woolman Rink, if you remember back in the 80s, they couldn't get it built. They'd spent, obscene amounts of money. Finally, the mayor at the time just gave up, and Trump came in, he got it built. He called a guy who had built hockey rinks for the NHL in Canada because he was a friend from Mar-a-Lago. The guy came in like no time at all. They built the most beautiful rink. It was working in like a month, on time, under budget. So it'll be interesting to see what happens to the carousel, the skating rinks, and the golf course, as they're no longer running it. But it is what it is. It's political payback, and that's the game. Stock market. So she said, if they're not focused on the impeachment, what is the stock market focused on? The stock market's focused on the stimulus getting done. Now it seems to be a little bit, sideways in terms of slightly less than expected. Also, it's getting to be a lot of money here. When you add it up, it's going to get close to, when all is said and done with the clean energy. I mean, we could start to approach 50% of GDP. And that's why you're seeing the 10-year yield start to blow out, because people don't necessarily want to be a creditor to that level of spending. So it might be a little harder to get into 1.9 through, maybe 1.1. We'll see. Obviously, it's a blue wave, but it's very tight in the Senate. So if you get a centrist Democrat might say, this is a little too much. What are we doing to our future? And the market's starting to digest some of that. Some of the language about dividend taxes going up for high income earners, and that whole narrative of higher taxes is also going to be a short-term headwind until there's clarity. The second thing the market's focused on is earnings, which started today. On balance, look, they all beat. Revenues were a little light in Citi and in Wells Fargo. But, you're coming out of a pandemic. Half the country's still sheltered in place, regional shutdowns. We saw the jobless rate spike because of these regional shutdowns and because of the case spikes in recent weeks. So, it's going to take a little while to get through that here. Soft spot, this stimulus, the $900 billion that's just gotten out, plus the now $1.9 trillion. Let's call it 1.5 when it gets through both houses, the House and the Senate. That's going to be a material amount of money. And then the most important thing is you can have all the money in the world, but until people get out of their house, it's not going to circulate. So the fact that vaccinations started off slow, now they're over 1 million a day. That's very, very positive for the stock market, and we'll move. And then finally, they were focused on the Fed, which Vice Chair Clarita came out that night and said that there will be no raise of short rates until inflation is over 2% for at least a year, and that's the story. So, and then Chair Powell came out the next day. He was also dovish, not quite as dovish, but dovish enough. And that was that. So thank you to Mariko Oy and Derek Kai for having me on Bloomberg. Then this was a busy week. Paulina Lykos over at U.S. News asked me to talk about Reits. And, Reits have been weak. They've not come back as quickly as the rest of the market. I think that's an opportunity. And what my quote in her article was, with the yield curve now at its steepest in several years, this is a good time for mortgage Reits. As rates rise, so I'm basically talking between the short end of the curve and the long end, what they borrow and the yield of what they buy, and short rates are going to stay low. This is going to be a good thing for REITs. I think there's an opportunity here. I think that certain pockets are inexpensive, and you can go ahead and see her article over at U.S. News and World Report. Thanks to Paulina. Next on Wednesday or Tuesday it was on CGTN America Global Business with Roe Ruttenberg. Thank you to Roe, and also Stephanie Savage for having me on CGTN America. We talked about China inflation CPI. Now their GDP targets are 8 to 9%. I've been talking about 5 to 6% in the U.S. for 4 or 5 months now. Everyone thought I was crazy. We're going to talk about now Wall Street consensus is starting to move up to where we've been. And Goldman put out a note this week, so we'll cover that. But as far as the China Global hit, just CPI was basically came in better than expected, and that was due to food prices rising. Feed costs rose, vegetable prices rose because they had to ship from the southern China due to the cold weather. Non-food prices were flat. PPI was better than expected for producers. The raw material prices were up. Metals, you're seeing it in metals, were better. And strong manufacturing recovery. So imports and exports numbers we saw were strong, and the China Beige Book showed that they expect to be back at pre-pandemic profitability within the first quarter of 2021 on improved construction demand. And the consumer has been lagging, but they're starting to catch up. The government is focused on the dual circulation program, which means more dependence on internal consumption, try to maintain exports. Obviously, the trade environment's become a little more difficult for them. That may change, and produce all their semiconductors domestically by 2025. and increase the middle class through narrowing the wealth gap. That'll be easier said than done, but that is one of their initiatives, as well as internal investment in high-tech manufacturing, EV charging stations, and artificial intelligence. So the risk to this, though, we talk about 120% debt to GDP in the U.S., which is World War II levels, and we got down to 60% 5 years later through growth. I think we'll probably have a similar situation if we don't overdo it. The problem is we keep putting out stimulus and stimulus and stimulus because we think we need more because people are at home. I mean, if we put out, as we put out vaccines and vaccines and vaccines, the magnitude of what we've already put out, 2.3 trillion plus the 900 billion, which was net 500 because 400 was carried over from the first 2.3 in the CARES, but still 2.7. Remember, GDP is only going to contract, 3.5. So, 700 billion. There's 2.7 plus another 3 billion of monetary support, and now you're adding on top of that another, 1.9 trillion, and then there's going to be another $1 trillion after that, plus maybe $1 trillion, $2 trillion for green and infrastructure plays. So it's a lot of money. So that's the bad news. The good news is the 10-year yield keeps increasing, and that's increasing the net interest margin, which has really happened in earnest like the last 6 weeks. So that's going to start to show up in Q1 net interest margin, net interest income for the banks. Again, that's a positive thing. Furthermore, all those stimulus checks, I put out an article, the bankruptcies, personal bankruptcies, were at a 25-year low. So people aren't spending the money, they're not running up their credits, and they're building up savings like we've never seen before, which we'll cover in this week's article. So China, on the other hand, is at 266% of GDP. It's expected to hit 275% of GDP, debt to GDP, this year. So the government said we got to pull back on stimulus. So while we're full throttle, they're starting to pull back already, which may be premature. And that's where I said that's the risk to their 8 to 9% outlook. They'll probably be okay, but they're pulling back the deficit spending from a record 3.6% of GDP to 3% of GDP. And we'll see how they navigate the increasing domestic consumption while pulling back the deficit spending before everyone's vaccinated. But nonetheless, they've had a quick recovery. They'll be the only developed nation to print a positive GDP in 2020, 2 to 2.5%. And that's just because they went into it earlier, a few months earlier than everyone else, because it started there and they came out earlier. So they had the benefit of basically an extra quarter. So thank you again to Roe and to Stephanie. Moving along to Tuesday, I was on the Clayman Countdown also with Liz Clayman, and also want to thank Ed and Jackie for having me on Tuesday. And what we were covering, there was the CES conference, the electronics conference, and GM was launching their flying cars and talking about their electric vehicle and autonomous vehicle future. And Tesla was up huge that day. NIO was up huge that day. And I said, she asked me about, was it time for these, what's going on with these stocks? And I said, look, Liz, the thing that I've learned in this business is opinion follows trend. Now that Tesla's up 776% in the last 12 months, and NIO is up 1,700% in the last 12 months, everyone wants them. They're priced for perfection. Tesla would have to grow 26% compound annual growth rate for the next 10 years and deliver 5.1 million cars in 2030 just to fulfill their current price target of $900. So you're paying for 10 years of possible perfection. You're paying for that today. So you're paying 212 times 2021 earnings for Tesla. You're paying 25 times sales for NIO. They have no earnings. Versus GM, which is going to launch 30 electric vehicles by 2025. They've invested $27 billion. They're trading at 9.9 times earnings, and now it's probably a little more because since that hit, GM's was up quite a bit this week. And they're going to have the EV Hummer. They're going to have, and they announced the EV 600 van, which FedEx, I believe, is partnering. Yeah, FedEx is partnering with them. They're going to do all their electric delivery vans, or quite a few of them, which is a big deal. And that's, 9.9 times versus 212 times earnings. That's a better deal. And then Ford, same story. Instead of 30 EVs, like GM, they're going to have 40 EVs in the next couple of years. 40 EVs and hybrid vehicles, $11.5 billion in investment by 2022. And they're going to have their electric vehicle F-150s probably at some point, and they're coming out with the electric vehicle Mustang very quickly, and I think they've got something like 250,000 reservations on those, trading at 9.45 times 2021 earnings, again relative to 212. What we're seeing though in countries like China and France, where EV subsidies are rolling off, is that sales are falling. So the minute the government steps out of that market and they don't become competitive on price, sales fall off. And in those areas where competition crept up, like EU and China for Tesla lost share, but the pie gets bigger. So I'm not terribly worried, but more competition is coming. Apple will be coming in down the road, etc. So that's something to keep an eye on. And my play, all these electric vehicles, even if you get to 5% or 10% in the next 10 or 15 years, what are you going to need to charge them? You're going to need electricity. And in the theme of the reflation trade and the commodity super cycle beginning again, which we've talked about in recent calls, my play was, to electrify it, we're going to need natural gas. And, many natural gas stocks have been left for dead. I named two, Range Resources and Jerry Jones deal, Comstock Resources. So we'll talk about those themes in this podcast VideoCast. Moving along, earlier in the week, I wanted to thank Chibuke Ogu again. This was about the weakness in tech earlier in the week, and I said the weakness was led by tech, and I think the banning of Trump's account by Twitter and Amazon stepping up against Parler brought a renewed focus on increased regulation and reining in tech. So with all these antitrust suits all over, the digital services suits in Europe, doing this type of unilateral action, justified or not, puts a worry of like, wow, these companies just have so much power. And I think the market started to say, okay, well, on the one hand, many people felt, okay, they can do this. That might be a good thing in the short term, but then why aren't they doing it to these other bad people in the world? And then it just starts this whole ball. And then what will be the impact when all the followers leave? So it just brought more attention on big tech's role in, good things and bad things happening, and then how they need to be regulated. But the moral of the story is regulated is the key word, and that's usually a smokescreen for taxed. And you heard President Biden talking about fair share. It was the context of these big tech companies paying, he said no taxes. So they're going to figure out a way, and they're certainly not going to let Europe get 6 to 10% of revenues from the Digital Services Act in taxes without getting their share first, or as President-elect Biden would say, fair share. So they're going to extract money from them, or they're going to impose regulation, and probably a combination of both. And that was acute on Monday and Tuesday, and that's what the market was sniffing out. And then lastly, Devik Jain and Meta Singh, thank you on Monday morning for thinking of me. And this was related to, again, the weakness regarding impeaching Trump in the Senate would take their eye off the ball on doing the additional stimulus. And we'll see that. I mean, I think the market's really grappling with that now because the trial doesn't happen in 10 minutes. And President Biden really needs to hit the ground running because we're in a sensitive situation. We lost 3 months or 2 months post-election with, kind of distracted leadership all around and distracted focus and case counts increasing. So, and shutdowns, regional shutdowns. Although now with the stimulus coming to the state and local governments from Biden, now it looks like New York is going to open now that they're getting their stimulus, their bailout, local bailout, which is great. I mean, open the economy, and hopefully California will follow their lead. Although they've got some really severe cases, despite their excessive restrictions in recent weeks. So the moral of the story is 1 million plus vaccinations a day. We need to ramp it up, and I think it's happening. It's getting organized. I would not be surprised in 2 or 3 weeks if we're at 2-3 million a day. You do the math plus the people who have been infected. What you're going to see is every time someone gets vaccinated, you take one side of the equation down, the virus is going to run out of hosts, maybe even sooner than herd immunity. So this could happen very, very quickly, and then the trillions of dollars that's in people's checkings accounts and all this stimulus is going to start to circulate, and that's why people are starting to price in inflation, and that's why the 10-year yield is going up, and that's why we believe the commodities are going to do well and value stocks are going to do well moving forward. Okay. Want to do a quick Ask Me Anything. Each week you can email your questions, info@hedgefundtips.com, and I try to cover them. John, who chimes in every few weeks, owns the newspaper group in Ohio, says, Thomas, thank you. As always, thank you for the great info all week. With talks of inflation and rising interest rates, is it time to look at bonds? If so, what are the options to do so? Also, with the fear of a bubble, how can one best protect their portfolio against a sharp pullback? Okay, so 2 things. When interest rates are rising and inflation expectations are coming, you generally want to be getting out of bonds because a small rise in rates can lead to a permanent impairment of capital. So I'd be generally avoiding bonds unless you have long bonds in your portfolio as a volatility hedge, which is a more complex thing, and it may not actually act in the way that you want to. So my general view is if you're doing bonds, you have to be very short duration because every 50 basis points up in the 10-year is going to have an impact on the price of your bonds, mark to market. And if you still want to have bonds, maybe try TIPS. TIPS is the ETF you can get exposure to inflation protected securities. At least you'll retain your purchasing power and get paid at the rate of inflation. So that's an option in terms of bonds. As far as fear of a bubble, this is recency bias. Yes, I said in the article this week that we may get ghosted, we may get a pullback or a consolidation. The market can correct in time or in price. But we're due to take a breather here. You got a new administration, you got distractions in DC. We have had a huge 75% run off the bottom of the S&P since March. It's natural to digest gains. But the recency bias is to think, oh, now we run up, now we're going to crash again. And that's not a way to look at it. We're at the beginning of a new business cycle. And this is when you get paid to buy. The laggards of 2020 will become the leaders of 21 and 22, and we're going to spend a lot of time on that, discussing it. So the opportunity, if the market is consolidating or even if you get a pullback or correction in the next few months, number one, I think we're going to finish the year up higher. So mid-teens from the beginning of the year. So even if you got, what would be the average intra-year drawdown about 14%, which I think is actually unlikely. I think 5 to 10% is more likely if we get that. I would just ride it out, and a 5 to 10% market correction will be more for individual stocks. So like banks could take a breather here. What a lucky opportunity after missing the 70% move in the last 10 weeks. If you're able to get something like Wells Fargo in the high 20s or low 30s, that's exciting. If you're able to get Bank of America, at around $30 for the long term, or Citi in the 60s, so all these things just and some of the energy stocks, maybe they'll take a breather. Oil's been straight up for a number of weeks. Maybe you get a pullback on that. And you can pick up some high quality names, the bigger ExxonMobils, etc., on a little bit of pullback. So again, You need to speak to a financial advisor. I only deal with accredited investors. This is opinion for informational purposes. The disclaimer is on hedgefundtips.com. Click on terms. But I just try to be helpful and, call it as I see it, and just share what I'm doing, and personally and with my clients. Now, how do you hedge if you really wanted to hedge? So let's just say you had like an S&P 500 fund, or SPY ETF, or VTI total market, or something like that. What you could basically do, if you had an instinct of when you were going to get the correction, etc., you could actually self-finance. Let's just say SPY was trading at $300. I don't know what that ETF is trading at, but whatever. Let's just call it $300. And it's January. You could probably sell a at the money 30. When I sell covered calls, I sell premium. I never sell naked anything. I'll do spreads, but that's a different game. But let's say I own the stock or the ETF. I would sell at the money, and so let's just say the 30-day at the money is selling for $3. It's, again, I'm just cuffing these numbers, but I might want to hedge 100%, but not limit my upside. So let's say I had 1,000 shares of SPY. I might sell 5 contracts 30 days out, which would cover half of my stock holdings. 1,000 shares, 5 contracts, it covers 500 shares at the money 30 days out. Why am I selling 30 days out? Because you get the greatest time decay within the last 30 days. So in other words, when you're a seller of premium, covered premium, you want the time value to erode as fast as possible, and mathematically it does so in the last 30 days. So I'd sell at the monies, call it February or March, and then taking that money that is against half of my holdings, I might be able to buy 1,000 or 10 contracts, 10 puts, not at the money, but slightly out of the money for free. So in other words, the money I took in by selling at the money calls against the stock I owned would be enough to buy full coverage for puts slightly out of the money. So if I sold them for $3, I might look for, if I sold 5 contracts for $3 at the money of calls, I might look to buy 10 contracts of puts slightly out of the money to cover 100% of the portfolio. If you did get, a slice through of 7.5 or 10%, you'd have full 1,000 shares would be covered. But if you were wrong, number one, the insurance didn't cost you anything. But number two, since you only sold half or enough 5 contracts, the other 500 shares could have unlimited upside, even if you were wrong and you overhedged or overfeared, which is possible and probable in the middle of a new business cycle. We overestimate with recency bias that the market's going to correct hard, and sometimes it just corrects sideways in price, and then you lose the upside on those 500 that you sold the money to generate. But the point is that you can still have upside, have zero cost for your hedge, because you made it for selling against half of your shares, and then you buy the puts against 100%. So it's a little complex, but look, here's what I would suggest is just suck it up and don't even think about it, because the market goes up over time. We're in a new business cycle. Trillions and trillions of dollars of fiscal and monetary support is there, and people are going to leave their house. You've got global pent-up demand, and just think 3 to 5 years out. Don't overly concern yourself with the short-term stuff, because it's a full-time job. It's a job that I love, but on balance, just now is you'll get pullbacks. The best thing you can do is have some dry powder, so when you do get 5 and 10% pullbacks in the market, and you get some great recovery trade stocks that would be down 12 or 15% in that, and you can add into that, that's the opportunity of a lifetime, because three years out they can be up 70, 100% plus, and that's where you make your money. So embrace volatility. Be excited if we actually do get 5 to 10% back, because I know a lot of people didn't get enough exposure in the weakness last year. You should be praying for pullbacks and have that cash go to work in this weakness, because very, very low probability that we get anything major like we saw last year. It's a new business cycle now, and even in 2010 and 11, after you had the huge run up off the 2009 lows, you had meaningful pullbacks, 10 and 20%, and you should have just held through. And a lot of people got tied up thinking recency bias that was going to go back to the 2009 lows, and they missed a decade run, and they kept trying to short everything, and it hurt them. So great question, John. I hope that's helpful. So I basically answered your question and said I probably wouldn't do that. Just hold some cash and add to high quality equities if and when you get any weakness in coming weeks or couple of months. And then we're probably going to finish out this year higher based on earnings, based on pent-up demand, based on the vaccination trending, based on 5 to 6% GDP, based on all these positive things happening. So moving right along. Okay, Wells Fargo. Stock surges too. Okay, so this was early in the week. You got all these upgrades going into earnings. And coming in, I was like, man, this is running a little hot. Is it going to be sell to news? I thought we'd get a pop and then we'd roll over, but we didn't get the pop because they were just priced to perfection and, going into earnings. But nonetheless, this guy at UBS put it as his top pick. Could you imagine in August when I was talking about Wells Fargo, if anyone came out with a top pick? I mean, So anyway, he raised his price target to $41. And he says sizable multi-year, it's still a sizable multi-year underperformer. Companies' weaknesses could turn into investment positives. Modest improvements in the efficiency ratio, which we've talked about quite a bit. They have the higher than all of them, and Charlie Scharf talked about it today on the earnings call, how he's going to bring that down. And slight reductions in loan loss reserve could yield outsized earnings benefits. They started to take those down from the student loan portfolio. They're going to be taking more down coming forward. The CFO was on at the closing bell on CNBC today saying the exact same thing. And Martinez said the risk versus reward profile of Wells Fargo appears to be asymmetrically positive. I agree. I absolutely agree. That's that. Next, Carlton English, who's my favorite bank reporter over at Barron's, put out this note. On earnings. And so Wells Fargo provision for credit losses fell by $800. So they took down $823 million of their credit loss reserve. So again, they were over-reserved in Q1 and Q2. That was our central thesis. 1 was the yield curve was steepening. 2, new business cycle. And 3 was they were over-reserved. 757 was from selling off a student loan portfolio. So they've got a lot more work to do on the general loans, but it's moving in the right direction. And Carlton points out, and she's been on this since day one, the bank's efficiency ratio has been higher than peers. So they're going to be taking that down. And the other aspect was the asset cap being the $2 trillion asset cap being removed will be a huge catalyst, probably at some point in 2021, which will be huge. But keep in mind, the stock was trading over $50 when they had the asset cap. So that would just be additional, moving forward. And that was that. So it was, beat on the bottom line, light on the top line from investment banking and some commercial, but that'll all come back. Then you had another article here from Bloomberg. CEO pledges more expense cuts after 1% reduction in 2020. So he brought it down a little bit. And we made significant progress identifying efficiency opportunities across our businesses, and we started executing on those initiatives. Restructuring charges. So yeah, they're still getting, part of the reason it was down today was the legacy restructuring charges. Again, they're one time, but investors that have been bagged in this thing that owned it at $50 and $60, that rode it all the way down to 21 or $20.82, and now they have to still deal with this every quarter. I think they're just getting tired, and that's good. When they cry uncle, that's when the stock can start to go, to really move. But okay, this was a key point. So Scharf pledged to eventually shave $10 billion off of annual expenses. Their net interest cost fell 5.2% in the fourth quarter to $14 billion. However, he said that the company now has a clear line of sight to a 10% return on tangible common equity, a key measure of profitability, and expects to get to 15% over the long term. Now, contrast that to 2020. It came in at 1.3% return on tangible common equity. And that was that. So cutting costs, net interest margin, taking down credit reserves, all of these pieces are going to fit into the puzzle. But this was a really bold claim to take it up to 15%, because we know he's going to cut the $10 billion over time. Those are a lot of outside contractors. But to get the return on tangible common equity up to 15% from 1.3, and it's got that operating leverage. So it is going to happen. It's not unrealistic, but that's a very positive statement that was covered today, but that's okay. That's going to create an opportunity for some of you in the coming days and weeks. Here's the yield curve. It's still steep like crazy. And as we see here, historically, when it goes from inverted to steep, financials start multi-year bull runs. And, multi-year bull runs, look, you get this kind of chop. That's part of the game. You get that chop. It's part of the game. So we'll have that, and that's fine. And, we're going to move. So, and then Carlton also covered the Martinez upgrade, and what he said was the upshot, Martinez over at UBS, the upshot of low profitability is that incrementally higher revenue and lower costs have outsized percentage point impacts on earnings. Again, that operating leverage. And he estimates that each 1% reduction in the bank's 2020 efficiency ratio could boost pre-tax earnings by 3.8%, which enables them to buy back more stocks. If you remember the CCAR catalyst, they can now buy back stocks, which they're starting to do in line with the formula. So moving right along to energy. Obviously, opinion follows trend, both on banks, up 70%. Now everyone wanted Wells, and of course it's got to sell off and breathe. And same thing with Citi. Same thing with energy stocks. They've had a huge run here, so now all the bullish articles are coming out. So take them with a grain of salt and use, like in my answer to John, use any weakness or consolidation over the next few weeks. Now everyone that's getting in late after the first leg up, as the late money panics out on a 5% or 10% pullback, you'll be able to buy it up. But this article from Simon Constable over at Barron's, oil producers are curbing supplies, expect the oil rally to continue. And quote, this is Art Hogan over at National Securities. We expect prices to peak at 65 and remain in the range of 55 to 65. Okay, and they're talking, and the extra million cuts from Saudi Arabia, which was a positive surprise, in addition to the long-term cuts, the 5.7 till 7.7 down to 5.7 until April of 2022. And then again, the key is going to be how quick the vaccinations get in, because I know so many people booking trips for, some even in March and April but that's probably too soon, but they've gotten their first dose and etc. But certainly for the back half of the year, a lot of people are already booking air travel. Cruise travel will probably be a little later than that. Road trips are going to be huge this summer. So you're going to see just a torrent of demand of these people that want to travel, and they've got a boatload of cash to travel with, and more coming. It looks like another $1,400 for lower income people is going to be coming out in the next couple of weeks, if they can get that through the Senate. So the House and the Senate. So that is more positive news. Softening dollar. So that's had a huge move. We might get a counter trend bounce here in Q1. So keep your eye out on that. I talked to CNBC Indonesia about that a couple weeks ago, that the trend was down, but you may see a counter trend bounce as we get this consolidation in the general market, a counter trend pullback. for a long-term uptrend at the beginning of a new business cycle. Now, this article just came out tonight from Barron's Avi Salzman quoting Tom Lee. And I like reading Tom's stuff. He says, I love this call, why energy could have a Tesla-like 2021. And his basis for this argument is that energy stocks used to make up more than 10% of the S&P 500. Last year, they fell below 3%, actually closer to 2%. And the view is, why put 2% of your portfolio in energy when you could just add another 2% to Alphabet, is what everyone was thinking. But the underweighting of energy, and this is what I was saying with pensions selling at the exact wrong time under the mask of, ESG, it's going to be very tough as these names start to, many of them are now up 50 and 70%, but, they'll pull back here, justifying starting to miss their benchmarks as that weighting goes up in the indices back up to, even if it only mean reverts not to 10%, but to 6%, the amount of underperformance they're going to have by being carbon free is going to be staggering. So I think you're going to see a lot of chasing back in at the exact wrong time. And how they'll do it is all these companies, I think I read Occidental is going to catch carbon in the air and do some kind of stuff, and BP has their whole plan. So all the companies will have their stuff, their narrative of how they're going to become carbon neutral and plant trees 30 years from now, and that will enable pension funds who have missed the first 50 to 100% to then jump back in saying they've changed their policy and they can buy up. And you, listening to this, will be able to lay off some of your stock that's up 100 and 150% to the pensions just getting back into the game when companies have come out with clear ESG policies that they can justify putting money to work. I do think, as I've said in the past, though, I think this move here will accelerate the renewable movement. I think if we do get another run in the next couple of years to $70, $80, $3, $4 at the tank, I think that's when the switching costs to electric vehicles, and obviously the cost of electric vehicles will be coming down at the same time, will become economic for a lot of people. And which is why I said to Liz that the play on EVs is actually natural gas, because those stocks are extremely cheap. And, here's one that I named Range Resources. And, this one is unbelievable. So, I started buying this at 1182 and it just kept collapsing. I think the basis is 422 on it now. It's up to $10 a share. And this is a long-term hold because I know we're somewhere in here in the secular run. So I know, 3-4 years out, this could be a $70, $80 stock, or a lot more, by the way. Electric demand is going to go up dramatically, and, the intermittency of renewables. So this is the bridge fuel, the bridge energy, and you see these ones that have stayed solvent. You have your ones that were over-levered, like Chesapeake's, they're toast. But, there's some left, like Comstock, like Range Resources, like Southwest, maybe even Antero, that are going to have these monster, 4 or 5 year runs, and they're going to be choppy as hell. You could buy it at 10, it could go back to 6. I'd buy more. But, if you look out, I think this is going to be back to 50, 60, 70, and maybe even more over the next 5 years. And, that you just can't get that in an index fund. So, having some type of allocation to this is going to make a lot of sense. So he's also embedded in his Tom Lee's argument as to why oil can become Tesla-like is the realignment of supply-demand outlook for energy is the most dramatic of any sector, Lee wrote in his report on Friday. The new White House is likely to limit future supply growth. Capital availability is limited as private equity unlikely to bail out the sector like it did in 2016, and demand is set to recover as the global economy reaccelerates. So the same basic argument that we've been making for months, but it was nice to see. I like the structure because, there's kind of like this panic buying into, or it has been this panic buying into Tesla, and opinion follows trend. And I think you're going to see that. It starts with the short squeeze, and then you get the panic buying into energy, And then, towards the top is when pensions are going to really start to get exposure again and chase it up. And that's when you're going to just see those parabolic moves. But that's probably a couple years off. This is an opportunity. If we do get that consolidation and sideways or even down in some of these names in the next couple of months, this will probably be the last time in this cycle to get the bigger names so you don't have to deal with bankruptcies. There will be more bankruptcies. But, for the next 3 to 5 years to get them. And for some of these are paying 6, 7, 8% dividends while you wait. Dividends are questionable. I wouldn't be buying them for the dividends. But, for the bigger ones, that's been their knitting. That's how they retain their investors until the underlying business starts to restore. So it's a cyclical opportunity and very exciting opportunity at that. So okay, this was awesome. So Wells Fargo was a top pick this week after moving 70%. And then JP Morgan analyst turns bullish on ExxonMobil for the first time in 7 years. He said, for the first time in 7 years of covering integrated oil since the peak of the sector in 2014, we are upgrading ExxonMobil to overweight. As we sit here today, we think that the bar is materially lower. Execution might finally be turning a corner. 2021 consensus too low at $50 a barrel Brent. And the 7% dividend yield is more secure and valuation is more reasonable, Gresh wrote. Perhaps most importantly, we think that capital discipline is improving with the 20 to 25 billion of CapEx budget, self-imposed step required to preserve the dividend and balance sheet. So that's, opinion follows trend. Those are moving. Here was Avi Salzman again over at Barron's. 5 stocks to play the next surge in natural gas, and he is the basic, and he covers Range Resources, Southwest, Antero. And again, these are stocks that you put a small percentage. Again, you get to consult with your financial advisor, terms and conditions, etc. This is opinion. But you put a small percentage of your equity and you just watch. If you put 2% and it goes up 7x, that's 14% gains just with very low risk. And if it blows out, or if you put 4 stocks in 2%. So these are really cyclical opportunities at the beginning of new business cycles where you can really do tremendous. So the largest market factor that they're naming in this call on natural gas is a shortage of liquefied natural gas, LNG, which can be transported by ship. Asia doesn't make much of its own natural gas, so it needs to import the liquefied version. And this year, demand for gas is soaring because the weather has been unusually cold. Remember, I mentioned in China they had to ship the vegetables from southern China, and that increased food costs. Well, they also need LNG. We have the other terminal now on the East Coast in Maryland, I think Cove Point, if I recall correctly. So these things are finally going to have their day in their sun after just languishing around. And maybe they'll bump around for another year and a half, but who cares? If 3 to 5 years out that they're going to be up 5 to 7x, you don't really care about the short-term volatility. And when you have extra cash, you just add on the weakness. So that's what it looks like long-term. And, they were saying the exact same thing in 2000 to 2002. And, it went, by the way, from 90 cents to $73 in 8 years. 90 cents. So 70. No, that's almost Bitcoin-like returns. 80x. No, so nonetheless, that's one piece of it. Here was an interesting article from Vanguard, the huge indexer. And their thesis is that value is now going to outperform growth because inflation is coming back. So they said the end of the value coma is coming. Our research indicates that a value premium does exist and that the recent outperformance of growth stocks can partially be explained by the downward trending long-term inflation levels and the lack of material acceleration in earnings growth over the past decade. So one of the things that was the narrative of recent years was the Fed was pushing on a string, like, we need fiscal spending. So now we have probably way more fiscal spending than we should have. And we're going to figure that out when all these vaccinated folks get out of their houses and start partying. And that stimulus money and that spending hits the economy like a torrent of cash. And we're going to see inflation and that 10-year yield. But But it'll be fits and starts for a few months before we see that. But this table shows how depressed it is, and it's exact same setup like when natural gas and oil were at these levels in 2000. Now, their thing is like they're going to do great, but they're going to do great because tech is going to do so poorly. I don't think that's the case. I think tech's going to do fine, ish. And I think that these cyclicals and value that we've been talking about for the last 4 to 6 months are going to just dramatically outperform. Not to say that it has to be fully at the expense of. So I'm less pessimistic on the rest of the market than Vanguard is, but I'm equally as optimistic on value cyclicals. And then inflation plays are outperforming deflation assets by the most in 15 years as money pours into energy sector and tips. This was by Steve Goldstein over at MarketWatch. And it's a Bank of America note that he's citing. He's talking about inflows into inflation assets and performance. Investors are pouring their money into the inflation theme. Last week, we saw the second largest inflow into energy stocks, the third largest inflow into tips, and the sixth largest inflow to emerging markets, and the largest inflows to bank loans, which are variable rate. That's also, John, you can look at bank loans. I'm not a huge fan, but they have adjustable interest, so it's something to consider. But according to Bank of America data, municipal bonds, which are exempt from federal and most state taxes, saw record inflows as well. So this is the kind of stuff. This second largest inflow to energy stocks, third largest to tips, sixth largest to emerging markets. Okay, so we have exposure to all that, and that's if you have to play the short term for performance measurements, that's usually when you want to consider doing a little bit of a short term hedge, just because everyone's chasing it after it's up huge. You'll get your 10 or 15% correction in these small pockets that have run hot, and for the large part, just ignore it and ride it out. Look 1 to 3 years out. We're going to be much higher. It's not worth it. Certainly, if you're in a taxable account, it's definitely not worth it. So I'm talking about these sectors, and they're ripe for some consolidation. So I want to be, I want to put these ideas out here, but I'm thinking from a 1 to 3 year term. They've had huge runs, so look for some weakness in coming weeks that you can get some exposure or add to your exposure. But don't get cute and try to play it like get out of everything and try to get in everything, because it might just keep running because a lot of money has missed it and a lot of money is chasing it, and there's been a lot of money pumped into the system. So don't get too cute. But if you do get the weakness, add. If you don't get the weakness, then just ride with what you got. Okay. Those on the podcast, as I promised, we have a lot to cover. We're 56 minutes in. This is going to cut off in 3 minutes. What you'll want to do is go to hedgefundtips.com and scroll down to the right side where it says VideoCast. Click on it. You'll see the YouTube video, and just fast forward to minute 60, the 60th minute, and you can listen to the last, whatever it's going to be, 10 minutes after you get cut off. You can view it on the VideoCast. It's word for word the same thing. Moving right along, this was related to the stimulus package, and part of the reason that the market was less than enthusiastic, the overall size of the package was less than the rumored $2 trillion, and the wide scope of the proposal implies that getting it through the Senate will be a Herculean task, especially with this additional friction of the trial happening. And that's what the market's been kind of pushing and pulling about this week is, you're going to impeach someone who's no longer in office, and constitutionally, it may not help you stop him from running again. I think that's already, who knows what the future holds, but I think it's, probably a low probability anyway. The high probability is get your package out, take full credit because it's a blue wave, and, just run the table and run the momentum versus slowing the momentum down to stop something that constitutionally probably can't be stopped and is unlikely to be happening anyway, 4 years out. So a lot of stuff changes in 4 years. So that's kind of what the push and pull is around that. Now, the plan is also going to lay out infrastructure spending and plans to attack climate change, and it will also lay out tax raising plans, which is catching the market off guard a little bit this morning. Jim Reed over at Deutsche Bank said, and that's true, so the increase in dividend tax potentially, and getting this stuff through Congress is going to be a little tricky. And I think they're probably going to push off they're going to jawbone the tax stuff hard. But I think to put it out too soon, unless it's just targeted at like big tech and over $1 million incomes, putting out too soon is really going to stunt the recovery and cost them more in terms of stimulus. So it'll probably be done closer to next year. And my guess it'll just be for high income earners. I don't see them wanting to go too crazy on the corporate tax. Maybe some type of alternative minimum tax for people not paying taxes, but we'll see what happens there. But that's what had it off target. We've talked in recent podcasts and videocasts about a mid-teens return based on all the statistics and all the different studies that we've done and talked about. Goldman came out to confirm that. They're talking about 14. They're expecting the S&P to rise 14% in 2021. That seems ballpark. And what they're saying is that GDP estimates are too low, which we've been saying since August. Consensus is at 4.2. They've just moved theirs up now to 6.4. So that is, certainly bullish, and I agree with them. I've certainly been 5 and 6. I've said it many times. And they also took their earnings up for 2021 at 178. If you look at 196, if you look at next year's earnings, now we're at 2022 becomes relevant. We're at 18 times in a low rate environment. That's pretty reasonable. So getting to 14% equity returns this year definitely seems reasonable. Moving right along. This is the Pring consumer staple model. We didn't cover that in the article this week, but this is one of the reasons I got a little cautious this week, just in terms of taking a breather. When this indicator spikes and then turns red and then rolls over, usually at the spikes are where you want to buy consumer staples. So consumer staples have been weak because risk has been on and the reflation has been on. Consumer staples do well when the market gets nervous again. Kind of like, I think actually long bonds will probably get a tiny bid in the short term if we get a little volatility in a intermediate term downtrend. Again, a counter trend like we talked about with CNBC Indonesia. But with all these spikes and rollovers, it was the time to buy staples. When it's time to buy staples, it's time to get out of, the stuff that's run hot recently. So that's why you might get a pullback in some of these cyclicals that have just run so hot since the election. And here we are again. Staples have been down. If you look at Kellogg and General Mills and Kimberly-Clark. And when they're weak, it's because risk is on, and then they look like, utilities and staples look like they want to get bid here. They're a little bit oversold. And so that's another reason that, I think, if these are rallying, the high beta stocks are going to start to just come in a little bit and take a breather after big moves. Next, okay, so here's the article of the week. We've covered most of it, so I'm going to go through it quick, but I want you to see the pictures. This was the TikTok until the stock market goes to sentiment results. Definitely check out this video. It's a trend on TikTok, and I did this whole explanation of how it applied to the stock market. But bottom line, click play. It's really a lot of fun what they're doing on TikTok. And the basis is that, we could still, and then you ghost, you correct, and then you wind up making new highs, and going back to where you were at the still, and then resuming the uptrend. And I think that's kind of where we're at here. Covered the TV stuff. And the other aspect of it was I was saying, well, maybe what's worked in 2020 and 2019 is going to start to get ghosted, meaning, it gets ignored and they move on to something else. And, it's very infrequent that any asset class holds the top spot for more than 2 years in a row before correcting pretty hard. You saw Reits do it in 2000 and 2001. And then they fell off pretty hard. And then now we've had large cap growth for the last 2 years has been in the one spot. Last 2 years before that has been in the 2 spot. So, this is just a normal cyclicality. You had European stocks. So that's what I did. So basically what I did was large cap growth is effectively tech these days. And what I did was I charted all the ones that I think are inflecting that you want to have exposure to over the next 3 to 5 years. And, for those who think they missed it, because small caps and emerging markets and banks and defense stocks and energy and home builders and value have moved pretty aggressively in the last 3 or 4 months. If you look at it from a longer term perspective, which is what we try to do weekly, take a step back. This rotation could be just getting started. If you look back here at 2000, a lot of things are pointing back to this, where tech starts to ease off a bit and, small caps start to take off as they did in the early 2000s. Emerging markets, what a huge run emerging markets has had. But look, relative to tech, it's just getting started like it was at that point in the cycle. What about financials? They're up 70% in 10 weeks, Wells Fargo and Citi. And look, it's just barely starting to outperform relative to tech. I mean, you could get moves like this, and that's where really fortunes are made. So defense stocks, just getting started. I still think this is the best. We've been pounding the table on banks, energy, and defense stocks. Well, banks and energy have had monster runs in the short term, just getting started in the intermediate to long term. But defense stocks are still heavy. I think this is an enormous opportunity. Remember our top 4 picks? Well, I'll cover that at the end. Energy, again, huge move, just getting started relative to tech. Home builders, huge move this year, just getting started relative to tech. And value relative to growth, just getting started even after a huge move. So if you think you missed it, think again. The new game is just getting started. Then I covered the consumer, just to show you the personal income. We covered this a little bit last week. Household debt service as a percentage of disposable income is at its all-time lows. Personal saving as a percentage of disposable income, with all this, they've got so much savings right now on the balance. So, you saw I think JP Morgan's deposits were up like $585 billion or some ridiculous thing this quarter, or for the year, but it's staggering. The vaccinations are ticking up. Fear and greed was 70. I think it closed the week at 60. So kind of, not overdone, but whether it's coming off for a downtrend or if it's going to take one last run up, we don't know. Like I said in the conclusion, market can correct in time or price. Time means it could just effectively grind sideways to up or sideways to down for 4 to 6 weeks, and that would be enough to digest the big gains off the March lows. Or in price, you could get your 5-10 or your normal 14% intra-year pullback. But, I think something significant is, more significant than any of that is likely off the table with the amount of money in the system and with everything starting to recover versus recede. Yeah, you had some regression from the shutdowns over the last 2 months, but the stimulus will be the bridge to the vaccine. And the top 4 picks of 2021 we covered on the 4th of the first, I think it was the first trading day of the new year, but January 4th with Liz. It was Wells Fargo, Walgreens Boots Alliance, Raytheon, and Exxon. So those are some stalwarts. Any weakness, that's an opportunity. And moving right along, the economic data for the week. We covered consumer sentiment was a little bit weaker. This is all related to the shutdowns, retail sales, continuing claims, which I've said is the most important number because it kept coming down. Everyone was always focused on jobless claims. Well, it went up this week. So that, eyebrow raised. That's why I think we could probably just churn sideways here or pull back a little bit until this gets resolved as the country reopens and the vaccinations kick off. Another big draw in crude inventories beat expectations, 3.24 million barrels. CPI was a little hotter than expected, and we're seeing it in wages too. So that's in line with our thesis and what happens with the reflation. The API draw was huge, and that was about it on the economic data. Earnings next week I covered with Liz. Pay attention to Bank of America and Goldman Sachs estimates are, expectations are a little lower now after Friday, so maybe they'll beat to the upside. And then Intel and IBM will be the first look into tech strength, their Dow components. So we'll see how they do on Thursday. This was the Russell top 30 weights. I did the earnings 60 days ago, and this weekend they're up 2.91% in the last 60 days. So that's good. No, I'm sorry. That was the IBD 50. Those are growth stocks, the top 50 weights of the IBD growth stocks, up 2.91%. The earnings estimates in the last 60 days. And then Russell small cap top 30 weights, the estimates were up 3.36% in the last 60 days. So estimates keep going up. And S&P earnings, they took a little dip, and then they've come right back up to 168.39. That's probably still too low. And then 196 for next year. So with that said, thanks for listening in. We covered quite a bit of information. I hope you found it helpful. Usually I have to talk a lot more when we're kind of at this inflection period, just to help people clarify in the short term. But then taking a step back, it's nothing. Look through it, and hope you found that helpful. So listen, have a great weekend. We'll be back next week, same time, same place. Make it a great one.